Welcome back, everyone. Today we're going to talk about capital gains. A lot of times we focus on real estate, and we'll still be doing that. A lot of people don't realize that one of the benefits of owning real estate is some of the income you generate from it could be taxed at preferential rates called the capital gains tax rates. So how do you actually achieve this? Well, it generally applies to assets that you hold for more than 1 year. If you hold them for more than 1 year, then you can essentially get this lower tax rate. Right now, it's about 20%, but it's phased in, so you could take advantage of lower capital gains rates, but let's just say 20% for simplicity. So there are 4 major ways that you can benefit from these rates. So first, and this is an easy one that a lot of people think of, is if you own stock and you sell it, well, you either have short term if it's less than a year, or you have long term if it's held for more than a year. So a lot of times you want to wait for that year to pass so you can cut your rate potentially in half or close to. But these next 3 are really the ones that we're going to focus on. So real estate, if you hold rental real estate for more than a year and you sell it, you can also take advantage of this capital gains rate. Another cool way to do it is if you have investment property. So here, obviously we're thinking about real estate as an investment in general, whether it's rental or it's land that's being held. But what I'm talking about for investment property is more like that land that you're buying for appreciation. That would be the sale of investment property versus the sale of rental real estate that you're actively renting it out. Also, the sale of a business could qualify for capital gains treatment. This could be the sale of any type of business, whether it's your management business for real estate or it's something else, a dental practice, whatever it may be. The sale of a business can get these preferential rates. It's really important to keep this in mind because you want to maximize your capital gains as opposed to your ordinary gains. Ordinary rates are those items such as your wages, maybe interest, and potentially dividends that aren't receiving the preferential rates. So those items of income are taxed at higher rates than some of these. And when it comes to real estate, the typical operating income, so the rents you're receiving, would also be ordinary type income. So you want to reduce that ordinary type income to the extent that you can and maximize your in-pocket cash by generating capital gains instead. Something to note, if you are a flipper instead, so you're really buying, rehabbing, and selling properties to make that quick buck, so to speak, then you're going to be taxed very differently than someone that's holding property for rent. So if you're flipping, you're holding it for less than a year generally, hopefully, because you want to be as quick as possible, generate that, and move it into the next property, you're going to be taxed at ordinary tax rates. So you're going to have to generate more income to get more in your pocket than if you're doing rental real estate. And then, really, if you want to fully take advantage of some of the tax breaks that rental real estate has, you may even want to try and avoid the capital gains tax. And that's where we get into things like the 1031 exchanges. So I hope you guys enjoyed this video on capital gains, and I'll look forward to seeing you in the next video.